Hi friends, welcome back to the Big Joy of Learning with Bijoy Ji. Let's continue with Money Matters Simplified. In the language of money, we are talking about key financial terms everyone should know. Today we are discussing about depreciation. Ever noticed how things lose value over time? This natural decline is captured in accounting through depreciation. Let's explore what depreciation means and why it matters. Depreciation is the process of allocating the cost of a tangible asset over its useful life. It reflects how assets like machinery, vehicles, or equipment lose value due to wear and tear, usage, or becoming outdated. Imagine your business purchases a delivery truck for 50,000 rupees, expecting it to serve for 5 years. Instead of recording the entire cost as an expense in the purchase year, depreciation allows you to spread this expense over the truck's useful life. There are several methods to calculate depreciation, each suited to different types of assets and usage patterns. 1. Straight-line depreciation. 2. Written down value depreciation. 3. Units of production depreciation. 4. Sum of the year's digits depreciation are few to mention. Straight line depreciation. This is the simplest method, allocating an equal expense each year over the asset's useful life. Calculated as asset cost minus salvage value of the asset divided by the useful life of the asset. Example: for a 50,000 rupee truck with a 5-year lifespan and a 5,000 rupee salvage value. First, subtract the salvage value from the cost, 50,000 rupee minus 5,000 rupees, that is 45,000 rupees. Now, divide this value by the useful life, 45,000 rupees divided by 5 years, that is 9,000 rupees, is the annual depreciation expense. Written down value method of depreciation. One common method of calculating depreciation is the written down value (WDV) method, also known as the diminishing balance method. In this approach, a fixed percentage is applied to the asset's book value at the beginning of each year, resulting in higher depreciation expenses in the earlier years and decreasing amounts in later years. Here's how it works. Determine the depreciation rate. This is typically based on the asset's useful life and company policy, or any statutory rates as defined in some acts. To calculate annual depreciation, multiply the book value at the beginning of the year by this depreciation rate. Update book value. Subtract the annual depreciation from the book value to get the new book value for the next year. Suppose a machine costs 50,000 rupees and the company applies a 20% depreciation rate using the WDV method. Year 1 depreciation is 50,000 multiplied by 20%, that is 10,000 rupees. End of year book value is 50,000 rupee minus 10,000 rupees, that is 40,000 rupees. Year 2 depreciation is 40,000 rupees multiplied by 20%, that is 8,000 rupees. End of year book value is 40,000 rupee minus 8,000 rupees, that is 32,000 rupees. Year 3 depreciation is 32,000 rupees multiplied by 20%, that is 6,400 rupees. End of year book value is 32,000 rupee minus 6,400 rupees, that is 25,600 rupees, and so on. Unlike the straight line method, which allocates equal depreciation each year, the WDV method results in higher expenses during the asset's early years. This approach is beneficial for assets that lose value quickly or become obsolete faster. Units of production depreciation. This method bases depreciation on actual usage of the asset. This method is ideal for assets whose wear depends on activity level. Depreciation is calculated as cost of asset minus salvage value divided by estimated production capacity multiplied by units per year. Example, if the truck is expected to drive 1 lakh miles. To calculate depreciation per mile, 50,000 rupee minus 5,000 rupees divided by 100,000 miles is equal to 45 paise per mile. Multiply this value by value of miles driven each year to find the annual expense. Sum of the year's digits depreciation. This is an accelerated method of depreciating asset. It assigns higher depreciation in early years using a fraction of the asset's depreciable base. Example, for a 5-year lifespan, sum the years 1 plus 2 plus 3 plus 4 plus 5 equals 15. For the first year, the fraction is 5/15ths, for the second year, 4/15ths, and so on. Multiply each fraction by the depreciable amount, 45,000 rupees, to determine annual depreciation. Understanding depreciation is vital for accurate financial reporting and tax planning. It ensures that asset costs are matched with the revenues they generate, providing a realistic view of a company's financial health. By choosing the appropriate depreciation method, businesses can better reflect how their assets contribute to operations over time. Continuing with the topic on key financial terms everyone should know, we will cover liquidity in our next session. Financial literacy begins with understanding the language of money. See you soon. This is Darpana signing off for now. If you found this helpful, don't forget to like, share, and subscribe to The Big Joy of Learning. Money Matters Simplified. Learn, grow, prosper. Have a big joy of learning.